Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe. Welcome, everyone. I'm Sean Payne, owner and founder of LivXplore Real Estate and Lifestyle. Today I have with me Isaiah Chast, our founding agent. I have Stuart Broughton of Supreme Lending and Alan Maciel, our broker, a commercial and a residential broker here in the office. Thank you, all of you, for joining us today.
Thanks for having us.
Good to be here.
So this is a podcast we've been really looking forward to talking about. It's the Cal HFA loan product, the Dream for All. And if you're seeing this, then you have a social media account, and you've probably heard about these products. They're all over the place. They're being pitched as pretty much the best thing ever that way. And so we brought Stuart on today. Stuart is not here to talk down on the loan product. It may be a viable solution for some people, but we're here to give like a balanced kind of view of it and make sure that you totally understand like everything that's going on with it, not just kind of like the catch lines, that you understand the guidelines and the position you're going to be in when you sell that home later on down the road. So again, Stuart, thank you very much for joining us. And
Thanks for having me.
Yeah, let's start talking about it. So,
What is it?
So what it is a down payment assistance loan of either 20% or however you structure with 50% with 5% going towards closing costs. It allows for the state to pay up to 20% of your down payment. Now we can get into what the numbers are and how that really works, and we can go from like a clock on to the beginning to the end on how this whole process works. But the gist of it is you're getting 20% from the state of California for your down payment, and we can go over the pros and cons of how this loan really looks on paper.
Right. So I mean, like again, just you hear about that. Wait, I get 20% down from the state. I mean, anytime you get money from the government,
right.
that seems like a great scenario that way. But there's a lot of stipulations to it.
Correct.
One is that when you sell that home or refinance something of that nature, that 20% has to be given back to the state. You have to pay back that loan. But on top of that, if you were to gain any equity, you have to give back 20% of your equity as well.
Correct.
Do you want to talk a little bit about that?
Yes. So how they structure it is the 20% down. If you did option for the 20% down from the state, you'd have to come up with your own closing costs. These loans are not cheap. There's points associated with them. There's a posted interest rate that all lenders have, all banks, everyone else has. So the rate doesn't fluctuate like that. And there are points with these loans. Right. So I ran a scenario in a $700,000 purchase, and you option for the 20%, you'd be paying $28,000 in costs,
right.
Which is pretty steep.
On what purchase price?
$700,000. So let's use the case of a $500,000 purchase, right?
Okay.
And the person's like, I have no money. I want to come in and just do zero down and not come up with a cent. That's fine. You can do that, but you need to understand how that really is broken down and how that works. So the 20%, they would give you 5% of that for closing costs. So in essence, you're really borrowing 85% loan to value of that purchase price. So let's use 500 for instance, right? So you're going to be borrowing 425. Right?
Okay.
You're going to be on the hook for 100.
Right.
Right? So you're paying mortgage insurance on the 85% loan to value, right? And your total complete loan to value when it's all said and done is 105%. So you're now owe 105% of the 500,000. So that is what people just need to understand if they option for the closing costs being paid through this 5% transaction.
So let's just to back up a little bit so people understand, because they've been hearing like pitch certain things.
Right.
The benefit of this loan in some scenarios is that you can afford more home than what you can typically afford, right? So like you can afford the mortgage the mortgage insurance that way, and potentially keep your if you were using the 20% down as your down payment and covering your closing costs at that point, because you have the 20% down, you can avoid the mortgage insurance that way, and which will allow you to have a lower monthly payment.
Correct.
Some people that'll be attractive to that way. You can also do the 85% down, but at that point you would have to pay for mortgage insurance. So you're not going to have as much break that way in the total monthly payment. And I think that's what some people are looking at is like, holy cow, with this 20% down, my monthly payment's dramatically lower and I can afford this and a little bit more home that way. So you have that option with this home.
Right.
But then if you do the 85% down, so if you use that
85% loan to value.
loan to
the
value,
loan of 85%.
right? Yeah,
correct,
exactly. I'm sorry.
right.
And you use 5% of that
For closing
20% gift for closing costs. You can come in with no money down, little money down,
Yes,
something like
yes.
that. But then let's reevaluate your monthly payment is going to be more similar to what it would be on a 5% conventional or 3.5% FHA, something of that nature. Just want to make that distinction so everyone understands that.
Right,
On that
right.
note, also, correct me if I'm wrong, but would you be qualified for a lesser purchase price if you did only 15% down versus 20%?
Yeah, I mean, you still have to qualify, debt to income ratio has to be at 45%. So total combined income has to be 45% debt to income ratio, and you have to fit the, income requirement, which in Sonoma County was pretty large. I think it was like, 220,000 or something, like combined income. But what I wanted to talk about is if you did option to not come in with any money, right, and you wanted those 5% to pay for that, literally, when you're walking away from this deal, you owe 105%. You're on the hook for 105% of this property. So you owe 525 on 500.
Right. So again, so you're using that down payment assistance, using 5% to cover your closing costs. That's not free money.
It's not.
So you
There's
have
no
to
free
pay.
lunch.
Yeah, exactly. So you
Right.
have to pay that back at the end.
Right.
Let's also
And-
be very clear, you're still coming up with the 5%, so it's not like you're coming in with nothing.
Well, that's if you do the 20% down.
Yeah.
If you do 20% down, you gotta come in, so like the
Exactly.
700,000, let's just use the 500, I don't mean to get off
Keep it easy
purchase
for me.
price here, yes. So 500, say the closing costs are 24,000 for
Okay.
500, right?
Right.
So your closing costs are 24,000, if you do the 20% down and they give you 20%,
Right.
then you come up with a 24,000 and you're borrowing 80% loan to value.
Right.
There's no mortgage insurance.
Right.
Your total liens are 500,000 for the 500,000 purchase.
Right.
When you option for that 5% for closing costs, you're tacking on 5%. You're hoping your value is going to go up 5% just to meet that requirement.
Right.
Right?
So, don't mean to interrupt you,
Go
but
ahead.
just to again, so with that 85%, essentially, and again, this is why I have concerns about this whole product, it's a no money down loan going into a strange real estate market.
Right.
That's setting people up for failure.
It can be.
It potentially can set people up for failure because you get a bad appraisal, the market drops 2%, you can't refi out of that product.
I'm glad you brought that up.
Let's go back to who gets this loan, okay? All right, because you can go to the 85% and it's not just an uneasy real estate market, it could be an economic uneasy.
No, yeah,
right?
I wanna
The whole economy
let's
have some issues.
Exactly. Let's preface that.
Yeah.
So as of right now, we have extremely low inventory. Right. We just don't have enough homes to sell. That seems to be insulating us a little bit from
Right.
from potentially what could happen in the economy that way. There's still going to be a pool of buyers out there. Right. So we as of right now, we're not saying the market's going to drop or anything of that
Right.
nature, but
Right.
experience is important.
Right.
We've been through this before, and we see what happens in the economy. That's Alan. Great point. Is that maybe the housing, is the whole economy where someone loses their job. Maybe
Right.
they have to take a pay cut. Something of that nature. And so you just want to position yourselves to be as safe as possible.
Right.
And yeah.
Getting
so-
back to the refinance, sorry, I had a brain freeze there. So on the refinances, you have to have 12 months of the payments
Right.
on time in order to refinance. So say you're at a 6 3/8 rate with mortgage insurance and rates drop. We're all thinking that the Fed's going to pivot at some point. Rates are going to come down. So say rates are at 4.5%. You're not going to be able to take advantage of that 4.5%
Right.
because you are fixed in that 6 3/8, whatever the rate is on that for 12 months. There's no getting out of that. You have to do that before you can refinance.
Right.
Now the other factor is the loan to value, and I'm talking about this 105% loan
Yes.
to value. So when you refinance this, you're going to go through a Fannie Freddie product. They will allow for 105% complete loan to value (CLTV) on these community second programs, these silent seconds, right?
Right.
So if
Okay.
there's any fluctuation in value, you're not going to be able to refinance unless you come in with money. And I think
Right.
that's very important to understand because we all know value is not saying maybe in Sonoma County, but say you're going to buy in Sacramento or one of the other counties where there was a fluctuation, say 100,000 or something like that. You're not going to be able to refinance.
Right.
Right. And
Right.
then we can get into the whole, shared appreciation. How does that?
We'll get to that in a second.
Right.
Yeah.
Right. And how does that pencil out to other types of loans?
Right.
So let's, I want to back up for me, is that for this loan, You may have resources, but probably you have debt that your resources have to go to the debt.
Mm-hmm.
And so therefore you don't have the resources for the down payment.
Right.
So this provides you with that either 85 to 20 or 15 to 20%
Right,
down
down,
payment.
right.
So in theory, that looks good. It's like, wait, I can take the money I have, pay some of my debt down, which is great,
Mm-hmm.
right? Get this money, right? And I will be able to get into a house, right? And so that's the upside,
Mhm.
right? But that's like I always talk about this circle, right? You got to close this loop on this thing. And so the good news is that this 20% potentially gets me into a house,
Right.
right? Right, wrong, or indifferent, gets me into a house. But now what happens, right? I mean, you talked about you got to wait 12 months. It doesn't really matter if it goes to 4.25. It doesn't matter how far it goes down. In the 12 months, you can't do anything
No, you
about
can't do
it.
anything about
You're
that.
stuck,
Mhm.
okay? Then the probability in 12 months, it's not going to go crazy down, but you don't know,
Right, we don't know.
right? And
Especially the way
so,
it's been.
but you're out of luck for 12 months,
Mhm.
right?
Yeah.
And then what happens if you not miss, let me phrase that, didn't miss it, you're late. You pay it,
Right.
but you're late. Has there been a definitive answer
Well,
or response to
How
that?
normal, conventional mortgages work is, you have to the 15th of the month to make the payment.
Right.
If you're past that, you're late. So
Okay.
I think if you had a situation in this 12-month, if you looked at the history of 12 months for someone paying and they paid on the 17th of 1 month, then you probably become ineligible to refinance. Now, I don't know how that works as far as, hey, if I did have a late payment, how much longer do I have to wait? Is it 12 months from that period? How does that all work? I haven't gotten into the
Okay.
details on that, but that could be another issue.
Okay, so I'm borrowing the 20%, right? No matter how you cut this up,
Right.
you're borrowing that 20% or the 15. It gets me into the house, right? I feel good about that. Now let's talk about what happens after you're in the house. Okay, well, let's clear the 12-month process. Okay, you know that we're out.
Mhm.
Can't do anything for 12 months, right? What happens after that?
Well, I mean,
It depends on what you want to do.
If I want to refinance, what happens?
Well, it all depends on your value.
Okay,
So if you want to refinance, you're gonna have that 105% loan to value. So you're gonna actually have to get 5% appreciation if you think about it. You bought
Right,
for 500,
exactly.
right? You're gonna
but this. Let's put that out. Let's put those
right.
numbers
No,
out.
actually,
right?
you'd have to have it appraised for 525. No, sorry, 500, but you owe the 105%.
Right.
So if there's any fluctuation and going
Right.
down from what you're buying from, like you have no room for error on that.
yeah, just a
If that
small
go- if-
percentage.
Yes, and we don't know how this is gonna work as far as, the appraisal process, we talked about
Right,
that.
right.
How's the state of California really gonna look at this, or the first mortgage holder, as far as, appraisals and the true value? So I think there's gonna be, some uncertainty there, but the gist of it is if that goes down in value, it's gonna hinder you from refinancing.
Okay.
Or if when you wanna sell, you're still on the hook for that 100,000.
Right.
You borrowed more than that, right?
Right.
You borrowed really 25% if you think about it. Or no, sorry, you're borrowing the 105% loan to value because you're borrowing the 85% and that 5% was just used for closing
Just went to closing costs, which you have to pay back.
Right, so you're actually owe more than what
Exactly.
is on the table.
Yeah, let's
Okay.
get to that. So and let's just use the 20% down, and then we'll show how like the 15% down even puts you in a worse scenario.
Right.
So we'll use the 20% down. But yeah, so that's regardless of what you've come up with, talking about here the guidelines. The problem that I had with this, hearing this about this product was, okay, these are first-time home buyers. How do you? Most of these people aren't going to live in the home. This is not going to be the last home they purchase, or that's the end goal, right? Is to eventually move up and buy whether it's a larger piece of property or whatever that way. Real estate. One of the important aspects of buying real estate is building wealth. That's really what it's about that way. And so looking at this program, just seeing, hey, you have to give that back, your original down payment, that 20% back, and then you have to give 20% of the equity that you've gained. What type of wealth are you building? And so again, from my perspective, I just see people getting pigeonholed into this home and not being able to move up down the road at the 20% down. I mean, with the 15% down and taking 5% paying towards your closing costs, you're even in a worse situation that way.
Right.
So, but Isaiah, you spent a lot of time. You've crunched pretty much every scenario possible. I don't want to say that to give a balanced picture here. I really don't like this loan, but we're trying to give a balanced picture here. But Isaiah's done a good job of crunching different scenarios, and maybe potentially there's one scenario that maybe kind of makes sense to me, but that's it, and it still doesn't make sense to me. So,
Yeah, I mean, again, I don't think this is a viable solution. I don't think that I've tried every situation possible to make this make sense. I'm still trying to find that. I don't think it does. So if you look at a typical, say, $650,000 purchase price, if that home were to appreciate 12% after all of the costs incurred with the program, giving back the initial 20%, giving back 20% of the shared appreciation, giving back, or not giving back, but paying selling costs, commissions involved, you'd be left with $55,000. You compare that to, say, a 5% down loan, not shared appreciation, you would be left with just under $110,000. So $110,000 is a significant amount of money that you could use to step up into your next home. Whereas with this 20% down share appreciation, you're really stuck in this home. You don't have a nest egg to use to move up to. You look at that same situation if you were to do, say, 15% down.
And have the 5% given for the
Yeah,
cost.
exactly.
Well, then you owe more.
right,
Because you're
Right.
borrowing your loan's 85% loan to value.
right.
So you say you buy it for 500, but they're really giving you 5% just for the closing costs. So you still owe, it's really 15% down.
Right, yeah, exactly.
With 5% going towards closing costs, but you're still on the hook for that 5%.
Right,
So it's really 105% loan to value,
yeah,
right?
If someone were to pitch a situation, it would make even less sense than any other situations. For example, if you were to crunch those numbers at purchase price $650,000, 12% appreciation, after returning down the down payment plus the cost for the closing costs, because you have to give back the 20%, minus the shared appreciation, you'd be left with $25,000.
$25,000 after owning that home for 5 years. Modest appreciation, 12%, which is, I think we don't have a crystal ball, but that's not too far off. $25,000 in your pocket to go get your next property. Like, I sell homes for a living. I make a living selling homes. That person should not buy a home. That person should go rent a home
And pay off their debt.
and pay off their debt and save money. And over those 5 years, they're gonna have more money in the bank than that $25,000 at that point. You
On
know?
top of that, keep in mind if you're renting, if you have a plumbing leak, a hot water heater go out,
Right.
the landlord pays for that. So now you're in a home that net with 12% appreciation made $25,000. But you think about the costs incurred over 5 years of home
Might be a
ownership,
wash. Yeah.
Yeah.
you might not be making any money.
Right.
Right. Yeah.
I just think that with this program, it can help certain people.
Yep.
You know, if you're going to stay in the home for 10 years, you're like, you know what, I'm not worried about values fluctuating. And I'm not saying anything's going to crash. I'm just saying
Right.
you got to look at what the fine print is and what you could be exposed to just in case, right?
Right.
So you just want to be careful in this loan. It could work for someone like, hey, I want to be here for 10 years. You know, I'm not going to move. I'm okay with that.
Right.
Well, but if you're at the point where like, hey, my family's growing, it's been 5 years, let's look at what the bills owed on this deal, and you're like, ooh, you know, if it any fluctuation, you know, that could be a problem. You just want to have that in mind when you get into this loan, that you could be stuck in that house.
Right.
Right? I mean,
It's-
unless you get some help from family or something to pay off the state of
Right.
California. I mean,
Right.
I get the 20, they take 20% of your equity, but you know, I'm not saying this is going to happen, but you have to think worst case, you know, you might have to come with money to the table just to get out of it.
Right.
Right?
And,
So-
you know, let's bring up a point. There are guidelines that allow that equity to be reduced. I mean, that 20% equity to be
On
reduced
lower income.
on lower income,
Right.
and you're not going to be able to qualify to purchase a home in Sonoma County if you
With
have
that lower,
if
super
you have
lower
that-
income bracket.
Yeah,
It's
right.
80% of the
Right.
AMI, which is I think $66,000.
Right.
But the 20% is always owed.
Yes.
You know, on the 500,000 purchase scenario, you always owe that 100 grand.
Unless I mean you know, a foreclosure or short sale or something of that situation potentially. So again, like setting someone up for failure, like you're kind of setting up someone for failure. That like, hey, you can get out of this through a foreclosure.
Right.
You know, like
Well, it's a little scary. I think
you
it's,
know,
for especially for the dynamic group of people that are going to apply for this. You know, every dollar
Sure.
counts.
Right.
That's scary. That's a scary kind of risk, I think, getting into something like this, especially doing the 15% with the 5% towards closing costs, because you're borrowing more than the home's worth.
Right.
If you think about it, you're getting the free closing, well, not free, but you're leveraging the closing cost and the down payment, and you're still at 85% loan to value. So when the bill comes due,
Right.
you're still
No, I mean,
gotta account for that.
Let's just take a step back and think about this. These are people that are struggling to get a down payment,
Right.
for a home that they can afford, right?
Right.
And here's a system that's giving them that mechanism to get in that home, but they're one step away from failing. Like there's like in this economy, if you get your wages reduced or something of that nature, someone loses a job. Like housing prices don't have to come down for you to be in trouble in this situation.
Right.
Like so that's what it is, and that's what it's really important in these times. Don't expect that to happen, but just have it in the back of your mind, prepare for it. So if it does, you're okay.
Right.
And I want to bring this up too, that with the 20% down scenario, your monthly payment is lower. I've heard some people say, oh, well, take that difference and invest it into another, reinvest that money. That doesn't happen. That's totally unrealistic.
It is very unrealistic.
That's
People are not
bad
going to do
advice.
that
For a
with that
first-time
scenario.
home buyer.
Yeah, for a
Right.
first-time
I've heard
home
that
buyer.
too, like throwing in a
And here's
CD
why.
or something like that.
Because
right.
you're struggling to get the payment for your first home.
Right.
So you're going to buy that home, and you're going to all of a sudden start putting away more money. No, you're setting someone up for failure. That's bad advice, and that's what experience is so important in this market. And that's what I see is I see. This reminds me so much of the 203K loans, that came out during the last time. It's the same thing. It's like we got this great product.
Right.
No one else has it. We're not at these rates.
Everyone
This
has
is
it.
really, really good. And then, like I said last time, I saw, agents and loan officers that were going to specialize in the 203K program, and 98 days later they're out of the market.
Yeah, I
and
did
so
see that as well.
and that's why I see
Yeah.
all this hype going on about this product reminds me about that. It doesn't make sense. There's better products out there, but it creates noise. It creates buzz.
Creates loan applications.
Yeah, it
and I
creates
think what a
loan
lot of people will
applications.
do is switch them to something else just to get them in the door.
Best situation.
Right.
I hope that's what's going to happen. Is that you call up your loan officer, you go through these scenarios, and that they say, hey, look, this FHA or this 5% down is 5% down conventional is a better product for you, and this is where you should go. But I think it's really important to note, we will put together these scenarios, include a link of these scenarios with this podcast, so you can go in there and download the scenarios and take them to your lender. But again, our whole point of this is to show a full picture that way,
Right.
and experience is so important. There's either two things. It's either that if you're giving this message that this is the best product in the world, it's either a little bit of incompetence and not being through an economic cycle before and kind of being new in the
Understanding
game,
how that works, right.
Or looking after your best interests and not your clients and just trying to get a deal done. Those are basically the two scenarios.
You nailed it on the head. I mean,
So-
the approach I take, and I think most loan officers should, is what makes financial sense for the borrower.
Right.
Right, you need to lay out all the options. This dream loan, and also FHA, conventional, lower down payments, and crunch the numbers. What's your equity, all that stuff, and really present all the different options so the borrower can understand it
Yes.
and understand what they're getting into.
Right.
Because there's a lot of hey, you get 20%, just get in. But you need to understand what you're getting into. All the things we're talking about now can be sticking points later. When you have the home, right?
Yeah.
And I think long term, no matter how you justify it over the next couple of years of getting into a home, I don't see it working out in the big picture. There's two ways it goes. Your home either decreases in value, and then you're on the hook for that if you had to sell, which most likely, I don't want to say most likely, but it's highly probable that the borrower in that position is more likely to get squeezed in an economic downturn.
Right.
So then you foreclose on the home and then you can't buy another home, you're left with nothing. Or the home value increases and your share of after selling your net return on investment, if you will, is less than if you did a 5% down loan. So in both situations, you don't really come out.
You know what it is? There's a lot of risk for the return.
Right.
Let's be honest, right? What's the risk and return on this? Your risk is I'm getting into this house at that loan to value of 105%. If I come in with no money,
Right.
and like you said, we're not saying values are going to go whatever. No one knows.
Right.
But that is something to really be careful about. You don't know
Yeah.
You know, what's gonna happen when you owe 105% loan to value on something you just purchased?
Right.
But it also
Right.
brings up another point, another component to this, right? You know, we've talked about the risk to the borrower, right? And there's significant risk. Yes, it gets you in the house, and here are the risks. But also, currently right now, what do you think the average time of an escrow is?
Oh, great point.
That's questionable.
It's all over the place.
Right. I would say you're probably 30 to 35 days on something like this, just to do it correctly.
Not this.
No, just okay. So yeah, just
Just-
to give perspective. Most of because volume's down right now.
Things are aggressive.
Yeah, I'm gonna say, Stuart, about 12 days
12
is what
day
we're
closes,
closing
yep.
transactions in, and you just do that's you can still get all your inspections done and everything of that nature. But I'd say like 12 days is probably what we're doing. We push the envelope a little bit to get it done to get our buyers' offers accepted that way.
Right.
But yeah, compare that to 35 days.
30 to 40 days?
Yeah, I mean,
It's
Depending,
30,
depending on how
35,
the
40.
state is
But no one
distributing
really
funds.
knows. It's not
Yeah.
like anything is funded.
Yeah,
yet.
no one's done it yet, so that's to be determined.
I think it's important. Like there has to
But
be.
you're right, there is a factor with timing, and when you write the contract, is it, putting an 80% first loan mortgage and then 20% in the contract?
Right.
And the seller looks at that, they might wanna be helpful, but there's a bunch of offers, what do you think they're gonna do? They're not probably gonna pick that
So you
loan
see, you
or
hear
that
agents
buyer.
all the time, even on a 3.5% down, just a straight up 3.5. Okay? They don't have any skin in the game. Now, you don't hear that if there's one or two offers, right?
Right.
But if there are multiple offers, I don't know why as an agent people say that.
Well, it's considered from appraisal standpoint.
Sure, but that's got nothing to do with skin in the game. Because I'm
Right.
about to take on a loan of $650,000 or whatever it is. That's a lot of skin, right? So I'm not saying that these deals can't get done if you take this loan and you have to write the close of escrow at 30 to 40 days, and you have to put down you have two loans that are either 100% financing
Or
or
105.
105% financing. It's not that they can't get done. It's just I think what we need to say is that the risks are significant, right? And transactionally, it creates another challenge for you. Not that they can't happen.
Right.
Right? It's not that these deals will never happen.
Right.
Okay? And then that gets back to how much money's in this fund?
Oh, yeah. So I've heard a lot of different opinions on that, and I think it's between 300 and 500 million. I don't know what it really
Right.
I
is.
saw it published 300 million.
Okay.
Yeah, I saw it published 300 million
So,
too.
I
But you
think
said it can be.
I think it could be replenished, and
Right.
I want to find out more about this. But what people are forecasting, I've heard, is that it might run out by July or August.
Okay.
So if you have an escrow that you're in June, that could be a little hairy.
Right.
Thinking that this might dry up. Now I think you can apply and get like an FHA case number, like how FHA works, and you can get that for the funds, and that be okay. But if you have someone that's negotiating a contract or something like that, and all of a sudden the spigot is turned off,
Right.
Then you have someone that can't qualify at all.
Right.
And that's heartbreaking.
Well,
Right?
let's go back to that. Like, so unless, you have two offers coming in, and you have one with this loan product and one with just a conventional 5% down, like as a listing agent, going to your client, I mean, you almost have to have a track record before you can advise them to take that loan, right? Because the track record of this 5% conventional, that thing will get done in 12 days,
Yeah, no,
right?
well, and
So
even
like
FHA 3.5.
right, yeah,
15
yeah,
days, easy.
yeah. So then you have this other one here. It's like, what's going to happen? I don't know. So like, can you advise your seller? Like, yeah, go ahead and take it. We've never seen this product before. It'll probably work.
Right.
It's the state of California. They're going to give the money. Yeah, it's going to be all great. So you don't really know how it's going to pan out. So can you really take that offer at first? I mean, there almost has to be a track record. And how do you get that track record? You have to go after properties that have no other offers.
Right.
Right?
Ultimately,
if you're
I think
competing
that's where you're
yeah,
right.
initially,
Right.
until there's a little bit of a track record, you're gonna have to go after properties that have no offers.
Even then, look at VA loans. VA loans are zero down, right? They're guaranteed, and agents still don't understand it.
No, they're easy,
And
yeah, they're great loans.
Yeah,
badmouth them. They don't, and they say the dumbest thing. don't have any skin in the game.
Right.
I always heard the seller has to pay for the closing costs or the
Yeah.
pest inspection, all this
Yeah.
stuff. No,
No.
it doesn't. They're easy.
VA loans are great loans.
They are
Yes.
a great loan.
They're fantastic.
The only difference is you get the appraisal done through the VA portal, and then they contact the appraiser. That's pretty much it.
Right.
Plus some other nuances, but yeah, they're not hard loans to do.
My point is that this type of a loan opens up the questioning of the offer by any agent,
Right.
Right.
I mean, rightfully so. Like
any agent.
you talk, like you said, you talk to 5 loan officers, you're gonna get 7 different stories, right? Like,
I know.
so
It's all education and knowing the guidelines and all that stuff, and I'm still learning some stuff myself. But yeah, I mean, you really want to have you want to be.
It's confusing.
It is. You want
Right?
to you want to be able to read the fine print on these things. And so, getting back to you saying maybe this is not a house that's on a street or part of a street that's not desirable, but that's the only house they can get. And you're going to buy that and have 105% loan to value on it, right? And it might not sell in certain markets.
Right.
So you're really sitting in a house that might not sell for what you need the money for.
Right.
And anytime soon.
Right.
So that in itself is risky.
Yep.
I think.
Right.
I mean, right? Does that make sense?
Or I mean, like you can go back to like the competing offer situation again, where like, in order for your offer to get accepted over that 5% conventional, maybe you have to come in $5,000 or $10,000 higher. And now potentially you may have overpaid for the home in this market, right? And so when we talk about
be in a worse situation.
yeah, and so we just talked about what happens if all of a sudden like someone comes back through and is like, oh well, your property necessarily hasn't dropped in value, you overpaid 10
And
grand
also-
to get it, right?
Right.
And so like now what you're then we're
Right.
getting in that situation. So
The appraisal process. So how's that going to work? We're
Right.
still finding out, like, is it just is this going to be like an FHA approved appraiser? Are they going to appraise it in a certain way? So if you do go over, is that going to kill the deal when you have a very
right.
strict
That would be the best thing for
loan,
you. Let them kill the deal.
a strict loan to value with the appraisal process that might not be very lenient? I don't know. I just think people really need to understand how this all really works before they go in and
Right.
go through the whole process. They need to really learn all the numbers, all the pros and cons, everything before they go ahead and do this.
If a loan is this difficult to understand, that is like the first sign to run.
Something's right. Right.
Run. If you have loan brokers, right, loan officers who
Have different information all across the board.
who know this part of it well, but they're not really well versed here, buyer beware.
Exactly.
Right.
Exactly.
Buyer beware.
Experience matters.
It
Experience
does,
matters right
big
now.
time.
So
And just to kind of say something, I mean, I'm all for affordable housing and all that stuff. I mean, I think there's a need for it. There's not a lot of inventory and all that, but to what cost to do this? I just think people need to understand that cost
Yeah.
to getting into a home. You know what I
Right.
mean? If they don't want to come up with any money.
hey, well, you get enough people into use these enough of these loans to get people into homes. We might have a little foreclosure crisis, and we'll make homes affordable again. So that's the last thing we want to do. I mean,
Well, I just think it's going to be hard for people to move up.
right.
You know what I mean? Like all those
They
things
won't.
we talked about.
They
It's
won't
loan to
also.
value,
They
it's
won't.
refinancing.
They
There's some caveats to this deal that people not to sound like a broken record really need to understand on this. You know what I mean?
Yeah.
So are we gonna be able to put together like when I say a fact sheet, like a bullet point? Kind
Sure.
of like, hey, this, you can do this, you can do that,
Mhm.
right? If we can get something like that out there, right, I think that would help people.
Right.
It can't be a big detailed sheet because nobody's
People get
gonna read it.
confused, right?
Well, look, we're confused.
Well,
We're
yeah,
sitting here doing
it's-
this.
Well, all the information's coming out too, so it's
Yeah.
like it's people. Like you said, there's no track record.
Right.
So it's learning the process, learning all the guidelines, being able to communicate that to your borrower, in a simple and understandable way.
Right,
You know what I mean? Which is going to be hard to do.
right,
Yeah.
Right.
correct.
Well, Stuart, so if someone wants to hear it straight that way and not just hear all about the good stuff, how do they get a hold of you?
Yeah, my phone number is the best way to get a hold of me. 415-987-8184. Call or text me. Be happy to help.
Cool, man. Thank you very much.
Yeah, thank
Well, I think this was a great podcast. Like I said, we were looking forward to do this, and I think we got a lot of information out there. What were we gonna say?
If we didn't mention already, we'll have a link for those listening for the numbers that we spoke about we didn't pull them out of thin air. It's real,
Right.
real data that if you look
Yep.
at it, I think anyone that looks at it and looks at A and B, they'll realize that this program does not make sense.
I mean, the best thing you can do, I think, as far as low downs and looking at this stuff, I still think doing a 3.5% down FHA, maybe getting some credits towards closing costs. Yeah, you're gonna be paying more in principal, some more in mortgage insurance, but you're getting all your equity. You're able to refi through a
Right.
streamlined refinance where they don't need an appraisal, they don't need income documentation.
Right.
You can do that off the bat. You're not gonna be, screwed.
Right.
There's no 12-month, seasoning period of on-time payments and fluctuations in markets with rates and all that. I mean, I think, if you put all these loan products on the table and have people just look at them, they can understand, hey, this might be a better option for me. I don't have a lot of money, but maybe I could borrow from my 401k, for the down, I could pay that back over time. It's not borrowing a lot. Maybe you can help me get a credit from the seller, Alan.
Right.
We can maybe work that kind of escrow close in 15 days, all that stuff. And I think that would be more beneficial coming out net money from your equity than this program.
Right.
So what you're saying is a good lender can be creative and not use a shiny penny.
Exactly.
Right.
Shiny objects.
Yep. Cool. So yeah, just to leave you guys that like when the economy is going bad, it's really important to kind of stick to the basics. Like usually like exotic new things just don't work out like in the long run that way. Stick to the basics that way. And on that note, if you've enjoyed this podcast, please hit like and subscribe so you'll see future episodes. I'm Sean Payne, Alan, Stuart, and Isaiah. Thank you very much for joining us today, and we'll see you guys next time.
Thank you.
Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe.